This is Just Ask George, exploring the universe of corporate finance and capital formation for your business enterprise, with merchant banker George Lovato Jr. and your host, David Wolf. Hi, folks. Welcome back to Just Ask George. David Wolf here, affiliate banker, and I'm with the head dude, George Lovato Jr.
Happy Friday again.
Thank you, George. And I got to ask, what's different about where we're broadcasting from this week?
Well, first of all, our viewers will notice that here, our back window, we're broadcasting high above Hong Kong somewhere.
Unbelievable.
Isn't it amazing, the power of technology? Seriously, every week we're going to have a new background. This is a green screen, folks, so we're not actually in Hong Kong. Although, in honor of the Hong Kong green screen, we're having Chinese food today for lunch.
Dude, I love it.
Isn't that great? And guess what happened this week? Just this morning, a few moments ago, we did the drum roll to see how many people watched the new show with the new video and all the new
the new venue, the new
890,000 views to the channel.
890,000.
890,000.
So you're in good company.
Yes. Thank you very much for watching.
Those of you new to Just Ask George, that's George and I. We talk about corporate finance. We talk about capital formation. And I'm honored to be the host of this, joined by George, who's one of the thought leaders in this space. And we're going to talk about, maybe it's misunderstood by some this week, we're going to talk about factoring. Factoring.
It's not about facts. It's about factoring invoices. People are often confused about what it is.
Right.
And they associate automatically, they think, oh my God, it's too expensive, you know.
Yes.
But that's really not the case. It is a very dynamic tool, and there are different forms of it that take place during the process of manufacturing and distribution and delivery and all that. So they have different little puzzle parts that you can connect together.
I want to insert a question here. For the broadest 60,000-foot view, when does a company know they need factoring? When is it the appropriate choice of capital?
We've got to go back to the 3 + 3 = the brass ring thing.
Brilliant.
And one of those points was, do the terms with your suppliers match the terms you've given to your clients? Okay.
In terms of timing.
Right, exactly. And so the issue is more to the point about, well, I've got to pay so much for raw materials, hard goods, cost of manufacturing, cost of distribution, and I'm going to be 30, 60, 90 days out before I'm paid after I ship the product. And so you've got to fund that timing difference. Factoring is the perfect tool because you can not only take that invoice and advance 80, 85, 90% of the gross amount of that invoice, and that money goes into your bank, but you can also factor the purchase order or the inception of the order. So that's part of the process too. Now, factorers typically identify themselves, I'm just a factor, I don't do PO. But it is one in the same part of the process. It's just two different dominoes linked together.
The PO part, or work in process, and I think that's a subset of PO, right?
Right.
That happens at the front end of the process of making the thing you make, the widget. Exactly. Factoring invoices, obviously, is you've issued an invoice to a credit-worthy client or a customer, right?
All under the guise of timing difference and working capital financing.
So how do you decide whether you should use one or the two in combination? Is there a way to, as a banker, do you...
Yeah, I mean, what does it cost the company to carry all of that inventory and soft goods and unmanufactured raw materials before it can be shipped? Okay, and then after it's shipped, you still have the terms to be paid. So it's a decision on how it impacts your cash flow and how heavy that burden is on you.
Okay.
Okay.
Excellent.
So this is one of the original tools that merchant bankers used, you know, hundreds and hundreds of years ago.
Yeah.
So it's evolved into the semi-regulated world. Some banks do it, not all banks, but some banks do have a factoring service. But now it's really dominated, the space is dominated by about 7 large companies in the U.S., and there's literally 500 to 600 small firms. So when we start talking about how that works and where the marketplace is and how open the marketplace is, it's really compelling. It's a compelling story, and it's become more popular with the economic downturn.
Now, I kind of, how would I say, skirted over this quickly, but when a factoring service provider is looking at doing factoring for a company, they're really looking at the end customer's creditworthiness, not the customer themselves. In other words, not the company or the manufacturer.
They're looking at the quality of the customer base, then the consistency of repayment.
Okay.
Then they're going to look at the credit and see how strong they are. I mean, if the customer ultimately has a very poor Dun & Bradstreet. Now, I'm not a real fan of Dun & Bradstreet, as you know, but I mean, that's one tool. Mm-hmm. If they have a very poor corporate credit rating, let's say, then the factoring company may slide back the advance rate. Okay, or they may increase a reserve amount. So instead of getting an 85% advance, they may get a 70% advance, and they may hold 10% on reserve on that client for a given period of time, 90 days, 120 days, so on and so on. So there's lots of ways you can adjust.
So these are the moving parts. They may create a contingency fund, if you will, or that reserve. That
account. Reserve, yeah.
Okay.
Yeah, it's another way to structure into the deal.
All right.
And the one point I'll make is conversations that I've had recently, which are actually kind of interesting, is I've suggested a timing difference mechanism, i.e. factoring.
Yeah.
And there's very little resistance anymore where they'd say, oh, that's too expensive. First words out of their mouth, that's too expensive. Now they're coming back with, well, how easy is it to do? And actually, in most cases, it's relatively painless. It just takes a little bit of time. But it's not like going through a normal bank underwriting. It's not anywhere close.
Really?
Yeah.
In terms of complexity.
When you compare the speed by which you get an approval with factoring as opposed to a normal commercial bank underwriting, it's like lightning.
Well, like you say, and I've had this happen with prospects that have called me. Their initial reaction, knee-jerk, is, wow, that's expensive money. I've gotten quotes. So the mistake, in my view, they're making is they're just looking at cost of capital.
Quotes.
Yeah, they're looking at cost of capital, and they're not looking at, well, what other options do I have to get this next?
I get them right off that subject, and I simply tell them, I ask the question, look, what's more important, access to capital or cost of capital? Is the fact that you don't have cash in the bank impeding you in some way, shape, or form in your business from growing your business?
Exactly. That's the question to ask, not how much is the money. Now,
what is the difference? Yeah,
exactly. It's really, well, there it is.
And cost is not one of those things, those subjects you just throw out the window. But in this case, this is a very flexible tool. So because of its flexibility and the overall ease of getting into factoring, there's a cost to that. And the fact that there are no limits, just like you have a line of credit with a commercial bank, it's got a limit. Okay,
there's a ceiling.
$500 million, $3 million limit. Yeah. It'll have a limit. With factoring, it grows with the business, i.e. the amount of receivables you provide. It just seems to chug along with those increasing amounts.
Nice.
So that is a big, big feature for a company on a growth path.
It's on a growth trajectory, wants to continue to grow, doesn't want to keep going back and raising more money. This is a scalable facility for them, and it's tied to the performance and the sale of those widgets.
Absolutely. All right, so it's being more widely accepted, and people are beginning to understand the flexibility. And I think the most important issue about it is it's not as misunderstood as it once was, and it's one of the oldest tools in the merchant banking arsenal.
I love when you talk technical about merchant banking. So merchant banking actually was founded on this idea of time difference.
I think if our viewers will go back to the website, and there's an article on the BH Capital website, and it's called "Another Variety of Banker," and in that article it describes how what the risk taker was like in the merchant banking formative years and so on, and what they did do. And they would buy inventories before inventories were put on ships, pay that merchant, and then follow that inventory overseas and wait for payment or make arrangements for payment once that inventory was offloaded on that ship, wherever it went, India to Italy, Italy to South America. It didn't, that's the way that they conducted business. They were the original middlemen.
Now, folks can come to BH Capital to get factoring, of course, amidst the other things that we do. One last question before we go. The mechanics of factoring, how does that work? Are they looking at individual invoices? Let's take the invoicing side.
Yeah, you have to. The process is a little taxing in the beginning because each invoice has to be confirmed by the factoring source. Mm-hmm. So they're actually picking up the phone and calling that customer and saying, "Did you buy this? And did you accept this invoice?" And it's a matter of due diligence. And once the factoring company gets comfortable with the client and the customer, then that lessens, and then they're accepting the invoice on the face value. So there's just a little bit of upfront or front-end loaded due diligence that's done.
So it finds its groove, if you will, and then it starts to become
usually
routine.
In about 30 to 90 days. And it runs like clockwork.
And then on the front end of the cycle of production, what are the mechanics in general terms of purchase order or work in process types of mechanisms of financing?
That front end is a little bit riskier, so that's going to be just a little bit more expensive. But what they're going to do is verify the relationship between the customer and the client.
I see. Okay. And in that case, I guess you may have multiple vendors that are contributing pieces of a good to make it the finished good.
Whether it's buying raw materials, putting it on the shelf, they're confirming that those raw materials are related to a contract specific or a purchase order specific. And then that's the same process, exactly the same. After a while, they get comfortable with the flow of the business of the client, and they know that he's going to buy 20 truckloads of lumber to make however many crates he needs to make or furniture he needs to make. And as a result, they kind of get in that rhythm, and then it smooths out, and it becomes almost seamless. So they get a 50% advance on the purchase order, and then when they create the invoice, it goes up to 80%, so they're getting another 30%.
Oh, so they run in tandem.
Exactly.
Right, so you got cost of goods over here, and you've got the invoiced amount over here.
See how flexible it is?
It's very flexible in those moving parts. Do they work together? Is there an intercreditory
Some factoring
agreement?
firms will finance inventory. They'll finance purchase orders. They'll finance the invoice. So not all of them do that, but some of them do.
Well, this is fascinating, and if you're in a manufacturing or really many, many types of businesses, this applies, as we now know. And you should give us a ring if that's relevant to your business or you want to learn more about how this thing works. This thing called factoring.
bhcapitalltd.com. They can learn everything, or they can go to
justaskgeorgeradio.com. They said,
boy, that sounded pretty good. We should have harmonized on that.
It was a polytonal moment for those in the music space that understand how I think. And next week will be somewhere else very colorful and beautiful.
I like that. What was the other line you gave me? You called it
what?
Something in the audio world earlier today. I wrote it down. Yeah.
You wrote it down? Let's see. Video upgrade.
You said it was something about the way it sounded, and I was going, God, I had to write that down. That was such a good.
This is the first thing to go, and I can't remember the second thing. But maybe
by
our next episode, I'll have it. So join us then, and you'll get the answer to that question and other things about capital formation. George Lovato Jr.,
another
BH Capital.
Good show. More about factoring.
We'll see you from somewhere next week on Just Ask George. Bye-bye. For more information about George Lovato Jr. and BH Capital, visit bhcapitalltd.com. Check out more episodes of Just Ask George at justaskgeorgeradio.com. Just Ask George is produced by Steve Garth and is a production of BH Capital Ltd. All rights reserved.